You don't lose money because the market is hard. You lose because your mind betrays you at the worst possible moment. The truth? Even professional traders, yes, the ones you think have it all figured out, fall into the same psychological traps. The only difference is they learn to see them, do you? Most traders walk into the market believing they are trying to beat price, predict direction, or outsmart other participants. That belief is comforting, but it's also dangerously wrong. The real battle begins the moment you click buy or sell, because from that point forward, it's no longer about the market, it's about you. Your thoughts, your emotions, your reactions under pressure, these are the forces that truly determine your results. Think about what happens after you enter a trade. The market moves slightly against you and suddenly your mind becomes loud. Doubt creeps in, you start questioning your analysis even if your setup was valid. Then fear appears. You begin to imagine the loss getting bigger, and without realizing it, you're no longer following your plan, you're reacting to discomfort. This is where the real damage begins, not because the market is unpredictable, but because your response is. On the other side, when a trade goes in your favor, a different kind of danger shows up. You feel good, maybe a little too good, confidence builds quickly, and that confidence can easily turn into overconfidence. You start thinking you've figured it out. You might hold the trade longer than planned, ignore your exit rules, or even jump into another trade impulsively. Again, it's not the market doing this to you, it's your own psychological reaction to being right. This is why two traders can use the exact same strategy on the same chart and end up with completely different results. One follows the plan with discipline, accepts the outcome, and moves on. The other hesitates, interferes, second guesses, and allows emotions to take control. The strategy didn't fail, the trader did. And that's a hard truth to accept. The market has no intention. It's not trying to trick you or punish you. It simply moves. But your mind assigns meaning to every tick. You take losses personally. You treat wins as validation of your intelligence. You create a story around every outcome, and those stories influence your next decision. Over time, this becomes a cycle, one where your internal state matters more than the external chart. Professional traders understand this at a deep level. They don't waste energy blaming the market. Instead, they observe themselves. They notice when emotions start to rise. They recognize the urge to act impulsively, and instead of obeying it, they step back. They build rules not just for entries and exits, but for their behavior. Because they know that consistency doesn't come from predicting price, it comes from controlling themselves. If you're serious about improving, you have to shift your focus. Stop asking, what is the market going to do? And start asking, how am I going to respond? That question is far more important. Because in the end, the market will always be uncertain, but your behavior doesn't have to be. The moment you realize that your biggest opponent is not the chart but your own mind, everything changes. You stop chasing perfection in strategy and you start building discipline in execution. And that's where real progress begins. Confidence is essential in trading, but it's also one of the most dangerous things you can have if you don't control it. It starts subtly. You follow your plan, take a few clean trades and they work. You feel in sync with the market. Your decisions feel sharp. Your timing feels precise. And for a moment it seems like you've cracked the code. That feeling is powerful. But hidden inside that confidence is a quiet shift that most traders don't notice until it's too late. The shift is from confidence to arrogance. At first, confidence is grounded in discipline. You trust your process, you respect your rules, and you execute without hesitation. But as wins stack up, something changes. You begin to trust yourself more than your system. You start believing that you can read the market beyond your strategy. You feel like you don't need to be as strict anymore because now you understand it. This is where the cracks begin. You take a trade that almost fits your setup, but not completely. You justify it. You increase your position size slightly because your last few trades worked out. You skip a proper confirmation because you're sure of the direction. None of these decisions feel reckless in the moment. In fact, they feel logical. That's what makes this trap so dangerous. Arrogance doesn't feel like a mistake. It feels like confidence. Then the market shifts, as it always does. The trade goes against you. Instead of accepting it quickly, you hesitate. After all, you've been right so many times recently. You tell yourself the market will come back, you give it more room, you ignore your stop loss, or you move it slightly. And just like that, a small loss becomes a bigger one, not because the setup failed, but because your mindset did. What makes this trap even more deceptive is that it often comes after success. Losing traders expect pain during losing streaks, but very few are prepared for the psychological danger that comes with winning. Success lowers your guard. It makes you less cautious, less disciplined, and more emotionally exposed. You stop doing the small things that protected you in the first place. Professional traders are not immune to this. They feel the same surge of confidence after a series of wins. The difference is that they don't trust that feeling blindly. They question it, they become more cautious, not less. They stick even tighter to their rules when things are going well because they know that's exactly when discipline tends to slip. They understand a simple truth: the market rewards consistency, not ego. The moment you start believing you're smarter than the market, you've already put yourself at risk. Because the market doesn't care about your recent wins. It doesn't adjust to your confidence. It will continue to move as it always does, unpredictably. So the goal is not to eliminate confidence, but to anchor it. Confidence should come from following your process, not from the outcome of your last few trades. When your confidence is tied to results, it will rise and fall with every win and loss. But when it's tied to discipline, it remains stable. In trading, the most dangerous moment is not when you're losing, it's when you feel unstoppable. Because that's when you're most likely to stop doing what made you successful in the first place. It only takes one moment of emotional weakness to undo hours, days, even weeks of disciplined trading. That's the brutal reality most traders don't fully accept until they experience it firsthand. You can do everything right, follow your plan, manage your risk, stay patient, and still watch it all fall apart because of a single emotional decision. It usually starts with a loss. Not a big one, just a normal losing trade. Something your strategy already accounts for. But instead of seeing it as part of the process, you feel it. It irritates you. There's a subtle frustration that begins to build. You were confident in that trade, and now it's gone. The loss feels personal, even though it isn't. At this point, you have a choice. You can accept the loss and move on, or you can react. And most traders, even experienced ones, feel the pull to react. You want your money back. You want to prove that the last trade was wrong. That urge is powerful because it feels justified. After all, you're not gambling, you're just correcting a mistake, right? That's the story your mind tells you. So you take another trade quickly. But this time, something is different. You're not as calm, you're not as objective, you're not fully following your process. Maybe the setup isn't as clear, but you take it anyway. Maybe your position size is slightly larger than usual. You're trying to recover, not execute. And that shift in intention changes everything. If that second trade loses, the pressure increases. Now it's no longer about one loss, it's about two. The emotional intensity doubles. Your thinking becomes narrower, more reactive. You stop analyzing the market and start chasing it. Each decision becomes more impulsive than the last. This is how one controlled loss turns into a series of uncontrolled ones. What's dangerous about this trap is how fast it escalates. It doesn't feel like you're making reckless decisions. It feels like urgency. It feels like you need to act now before things get worse. But in reality, every action you take in that emotional state is pushing you further away from discipline. Even professional traders experience this urge. They are not emotionless. They feel frustration, anger, and the desire to win back losses just like anyone else. The difference is not in what they feel, it's in what they do next. They recognize the shift. They notice when their mindset changes from calm execution to emotional reaction, and most importantly, they have the discipline to stop. Sometimes the best trade you can take is no trade at all. Walking away after a loss is not weakness, it's control. It's the ability to protect your capital and your mindset at the same time, because once your emotions take over, your edge disappears. Consistency in trading is not built on how well you perform when things are going right. It's built on how you respond when things go wrong. Anyone can follow a plan when they're winning. Very few can stick to it when they're losing. That's why one emotional trade is so dangerous. It's not just about the money lost in that moment. It's about what it triggers, the chain reaction of poor decisions that follow. And if you don't interrupt that cycle early, it will keep repeating. In the end, discipline is not tested during easy trades. It's tested in the moments when everything inside you is telling you to act and you choose not to. There's a strange pressure in trading that makes you feel like you always need to be doing something. Watching the market move without you in it can feel uncomfortable, almost like you're being left behind. You see price accelerating, candles pushing strongly in one direction, and your mind starts racing. This is the move. I missed the entry. I need to get in before it's too late. And just like that, patience disappears, replaced by urgency. This is where most traders lose, not because they don't understand the market, but because they can't sit still. The idea that action equals progress is deeply ingrained. In many areas of life, doing more leads to better results, but trading doesn't reward constant action. In fact, it often punishes it. The best opportunities are limited, and they don't appear on every chart, every hour, or every day. Yet traders feel compelled to participate anyway, as if staying out of the market means missing out on success. So they chase, they enter trades late, after the move has already happened. The risk is higher, the reward is smaller, and the structure is weak. But none of that matters in the moment because the decision isn't coming from logic, it's coming from emotion. It's driven by the fear of missing out, the fear that this could have been the one trade that made the day, the week, or even the month. What most traders don't realize is that missing a trade is not a mistake. It's part of the game. There will always be another opportunity. The market is not a one-time event, it's a continuous flow. But when you act out of impatience, you're no longer trading opportunities. You're reacting to movement, and reaction is where discipline breaks. Professional traders understand something that beginners struggle to accept. Inactivity is not wasted time. Waiting is not passive. It's a decision. It's a form of control. When a pro trader sits on their hands, they are not being lazy or hesitant. They are protecting their edge. They are refusing to engage unless the conditions are right, because they know that every trade has a cost, not just financially, but mentally. Every unnecessary trade drains focus, increases emotional exposure, and creates more opportunities for mistakes. Over time, this adds up. Not taking low-quality trades is just as important as taking high-quality ones. Patience also creates clarity. When you're not rushing to enter every move, you can observe the market more objectively. You start to see patterns more clearly. You become more selective. And that selectivity is what separates consistent traders from those who are constantly chasing. The irony is that the traders who take fewer trades often make more money. Not because they're lucky, but because they wait for situations where the odds are in their favor. They don't need to be right all the time. They just need to be right when it matters. But this level of patience doesn't come naturally. It has to be developed. It requires you to sit through the discomfort of doing nothing while the market is moving. It requires you to accept that you will miss trades and that it's okay, because the goal is not to catch every move. The goal is to execute your plan with precision. In trading, action feels productive, but discipline is what actually pays. And sometimes the most profitable decision you can make is to wait. Losses are unavoidable in trading, yet most traders spend their entire journey trying to escape them, not manage them, not accept them, but avoid them completely. And that's where the real problem begins, because the issue is never the loss itself, it's what happens inside your mind the moment that loss appears. When a trade goes against you, something shifts instantly. There's discomfort, a quiet resistance. You don't want to close the trade because closing it makes the loss real. As long as the position is open, there's still hope. The market could turn, you could still be right, and that hope becomes dangerous because it starts to override your rules. So instead of exiting where you planned, you hesitate. You give the trade a little more room. You move your stop loss slightly further away. It doesn't feel like a big decision, it feels like flexibility. But in reality, it's the moment you step out of discipline and into emotion. The deeper the trade goes against you, the harder it becomes to accept. Now it's not just about a small loss, it's about being wrong. And for many traders, that's what hurts the most. Not the money, but the ego. You believed in the trade, you trusted your analysis, and now the market is proving you wrong in real time. Instead of accepting that outcome, you start negotiating with it. You tell yourself you'll close the trade if it gets just a bit worse. Or you convince yourself to hold until it comes back to break even. You shift from managing risk to avoiding pain, and that shift is where small losses begin to grow into large ones. Professional traders don't enjoy losses either. They feel the same resistance, the same discomfort, but they've trained themselves to respond differently. They don't argue with the market. They don't try to be right. They focus on executing their plan, even when it's uncomfortable. When the stop loss is hit, they exit. No hesitation, no negotiation. Because they understand something critical. A small loss is controlled, a large loss is emotional. Every trading strategy is built with losses in mind. They are part of the equation. They are expected. But the strategy only works if those losses are kept within limits. The moment you start interfering, moving stops, holding longer than planned, you break the math behind your edge. And this doesn't just affect one trade, it affects everything that follows. A large, unmanaged loss creates emotional pressure. It shakes your confidence. It makes you more reactive in the next trades. You might become overly cautious, afraid to pull the trigger, or you might swing the other way and try to recover quickly. Either way, your decision-making is no longer stable. Accepting losses is not about being passive or careless. It's about being precise. It's about knowing exactly how much you're willing to lose before you enter the trade and honoring that decision no matter what happens next. In trading, being wrong is inevitable. Staying wrong is a choice. The moment you learn to accept losses without emotional resistance is the moment you take back control. Because now you're no longer reacting to the market, you're executing your plan. And that's the difference between a trader who survives and one who eventually breaks.